Hey everyone, and welcome to The Explainer. Today, we're jumping straight into the absolute architectural blueprint of a brand new financial product. Now, let's be totally honest here. An 80-plus page financial and legal rulebook, yeah, it's not exactly glamorous beach reading. But, it is absolutely vital if you actually want to know what you're buying. So we're skipping all the marketing fluff today and looking directly at the scheme information document that was just filed for the Motilal Oswal Nifty Oil and Gas ETF. If you've ever wanted to know exactly how a fund is built from the ground up, well, this is where you find out. We're going to examine the investment mandate, the strict constraints, and the hidden mechanics of this specific fund. Okay, let's dive into this. Here is our roadmap for breaking down this dense document. First, unpacking the new ETF. 2, the passive mirror strategy. 3, strict asset allocation rules. 4, the tracking error factor. And finally, 5, understanding the risks.
Right, let's kick things off with Section 1, Unpacking the New ETF. So the AMC, or asset management company behind this scheme, is Motilal Oswal Mutual Fund. And right there in the document, it explicitly states this is an open-ended, exchange-traded fund. Now, what's the ultimate goal here? Its investment objective is strictly to replicate and track the performance of the Nifty Oil and Gas Total Return Index. Essentially, it's designed to give you returns that closely match the total returns of those underlying securities, before expenses are taken out. So right off the bat, we know this is a highly targeted thematic play specifically in the energy sector.
Of course, whenever we look at a fund, we absolutely have to look at what it costs to keep the lights on, right? The AMC estimates that up to 0.90% of the daily net assets will be charged to the scheme as a base expense ratio. Now, this maximum limit, it covers the whole shebang, everything from investment management and advisory fees to registrar expenses, marketing, and even the cost of statutory ads. To put it simply, 0.90% is the absolute maximum friction you can expect to pay for the AMC to actually run this vehicle.
Moving right along to Section 2, the passive mirror strategy.
The official document is incredibly clear on this point. This scheme is managed passively. It acts like a perfect mirror. The fund managers are going to invest in the constituents of the Nifty Oil and Gas Total Return Index in the exact same proportion as the index itself. That means no top-down economic forecasting, no bottom-up stock picking, and absolutely zero subjective analysis of a stock's individual merit. Literally, if a company is in the index, it's in the fund. And if it gets dropped, well, it gets dropped from the fund too.
So, the crucial point is that this lack of active management actually cuts both ways. The document explicitly warns that the AMC will not attempt to take defensive positions in a declining market. Because it's a strict mirror, if the global oil and gas sector takes a massive hit, say from macroeconomic factors or some geopolitical event, this fund is going down right alongside it. It is entirely exposed to the raw volatility of its underlying benchmark. No safety nets here.
Which brings us to Section 3, strict asset allocation rules.
The investment mandate outlined in this rulebook is totally inflexible. As you can see from the strict data overlay here, a minimum of 95% and up to a full 100% of total assets must be invested directly in the constituent stocks of the Nifty Oil and Gas Index. That leaves a maximum of just 5% that can be parked in liquid schemes or money market instruments. And honestly, that tiny 5% slice, it's purely functional. It's just there to manage day-to-day cash flow needs, handle any redemptions, and basically keep the fund operational.
Now, because those portfolio limits are so incredibly strict, the fund has hard deadlines for fixing any drift. If market movements accidentally push the portfolio out of that 95% minimum alignment, the fund manager has exactly 7 calendar days to forcefully rebalance it. And that same 7-day clock applies if the underlying index changes its constituent stocks or if some involuntary corporate action leaves the fund holding a security that doesn't belong. The mandate dictates constant, rapid realignment to the benchmark. No exceptions.
Let's transition to Section 4, the tracking error factor. So what is tracking error? It's essentially the tiny crack in our passive investment mirror. Think of it like a shadow. While a shadow generally follows a person's exact movements, the angle of the sun might cause it to occasionally lag or stretch a bit, right? Similarly, the actual return of this scheme is rarely going to match the total return of the underlying index down to the exact decimal. There will almost always be a slight variance. The document actually quantifies this shadow for us. Under normal market circumstances and based on past one-year rolling data, the fund manager aims to keep this tracking error under 2%. Now, they'll obviously strive to minimize it as much as mathematically possible, but they do legally warn that extreme market volatility or force majeure events
could potentially push the error beyond that 2% threshold. Now, what's really interesting about this slide is understanding the friction points that guarantee this deviation. Think about it. The index itself is just a theoretical mathematical model. It doesn't pay fees. The actual fund, however, does. So, every time the fund pays a fraction of a percent for management fees, it lags the index. Keeping that 5% cash balance for redemptions, that creates a drag too. Even basic market mechanics cause friction. You can't buy fractions of shares on the Indian exchanges. So rounding off whole shares mathematically guarantees the fund's weights will always be just a microfraction off from the index.
Okay, finally, let's look at Section 5, Understanding the Risks.
And this brilliantly illustrates the reality of the situation, drawn directly from the source material. The official riskometers show that both the underlying Nifty oil and gas benchmark and consequently the scheme itself carry a very high risk rating. The AMC wants to make it abundantly crystal clear that this is not a conservative wealth preservation vehicle. The primary driver of that very high risk rating, that would be concentration risk. This fund restricts its investments entirely to a single sector. Because it lacks any broader market diversification, you as an investor face extreme exposure linked directly to things like global commodity prices, shifting geopolitics, environmental incidents, and intense regulatory shifts specific to oil and gas. Simply put, a bad day for energy is a bad day for this entire portfolio. There is zero safety net from other sectors like tech or healthcare to cushion the blow. Let's move to and see how this builds into their exit strategy. Normally, retail investors just buy and sell ETF units on the secondary market stock exchange. But what if the market completely seizes up? Well, the document actually outlines specific downside protection triggers called liquidity windows. Basically, if the ETF trades at more than a 1% discount to its actual net asset value for 7 straight days, or if exchange quotes just completely disappear for 3 days, retail investors get an escape hatch. Under these super rare conditions, you can bypass the exchange entirely and redeem up to 25 crores directly with the AMC, and get this, without paying an exit load.
Which leaves us with this final thought. We've unpacked the strict 95% asset allocation, the forceful 7-day rebalancing mechanics, the realities of tracking error, and of course that very high concentration risk. This fund executes its specific mandate perfectly by design. But that design isn't for everyone. So when looking at a vehicle tied entirely to the highly volatile fortunes of the energy sector, you really have to ask yourself, how does a highly concentrated, strictly passive ETF actually fit into your own long-term, diversified investment strategy?